Welcome back. This chapter is all about internal controls and cash. In my opinion, this is one of the most interesting chapters to read, quite honestly, because it really does a lot of focusing on internal controls. And internal controls are really what's put into place to try to avoid as many fraudulent activities as possible. Just to give you an example, do you remember way back when you were in grade school and you learned about how the government works and how there were checks and then there were balances put into place so that this way, everybody was equal and everything was treated fairly? Well, it's kind of like that with internal controls. Internal controls are put into place to try to limit as many fraudulent activities in a business as possible and to make sure that everything is reported properly and fairly. Now, internal controls is not a new concept. They've always been in place. And what I mean by this is that there are often times in businesses there are internal controls. For example, if you've got an accounts receivables person and their job is to collect the money when it comes in the door, and their job is maybe to write down who paid who paid who what, and they would apply the checks to the right people and make sure that the records are kept up to date. Well, that same person probably shouldn't be in charge of actually taking the money and depositing it at the bank. Because what would stop that person from taking the money and depositing it in their own bank accounts and recording it as received in the ledgers? Okay, so the idea is that this is really about the separation of duties, internal controls, to make sure that you're limiting the opportunities people have to do something fraudulent. And the chapter lays it all out incredibly well, and interestingly enough gives you many examples of how fraudulent things have come to pass, how many examples of activities that people have engaged in and how they've been caught. Just to give you an example in your everyday life, an example that I give in my classroom, things are internal controls that you guys don't even realize are internal controls. For example, if you think back to, have you ever been through a drive-through at a fast food restaurant and there are two windows? Well, those two windows may be more efficient, but they're also actually an internal control. And the reason being is if you go to the first window, think about what you do there. You always pay your money at the first window. You paying at the first window, the act of your giving the cash to that person in the window, what they have to do on their end is they have to record your order, or you won't get your order when you go to the second window. Now, let's just say they didn't record your order and they put your $20 in your pocket that you just paid for hamburgers. And you go to the second window, well, there would be no food waiting there for you because the person in window number 1 did not enter your order into the computer system. Okay? So that's actually a catch for an internal control, because think about what would happen if you were back to the days of having one window, right, where you're paying and you're receiving your food from the same window. What would stop that person, that cashier, from taking your money, putting it in your pocket, and taking your hamburger and meal and giving it to you? Really nothing. Nothing's going to stop them from doing that unless somebody's standing there watching them do their job, which probably isn't going to happen. So it'd be very easy for someone to steal the money and deliver you their food, because it's not as if they keep a tight watch on how many hamburgers are out the door. I mean, things get thrown away all the time in those types of situations. So really, two windows is an internal control. They're separating the person collecting the cash from the person delivering the product. One other example of an internal control you also might see pretty often, and you may not even think about it, is actually the customer is the internal control in this scenario. What the scenario is have you ever been to a place where it says, if you do not get a receipt, your meal will be for free, or whatever will be for free? Well, the reason that is there is because you as the customer are standing there and you're buying whatever you're buying, a soda, a hamburger, whatever, from somebody, and you know that if you don't get your receipt, your meal's for free. So you're almost kind of hoping that you're not going to get your receipt, right? So so you're looking to receive that, to get that receipt. Now, if the cashier was, in a fraudulent state of mind and they decided that they needed a little bit of extra cash, they can't pocket your money, because if they pocket your money, that cash register is not going to print out a receipt. Okay, so the idea is that you're forcing the customer is basically forcing the employee to put your order into the cash register, and once it's in there, that's it. the sale has been recorded, and the owners will expect to see cash in the till. Ooh, did my screen just go black? Sorry about that. Okay, so just one other example that might come to mind would be, have you ever seen at a grocery store or a Target or somewhere like that, have you seen that someone has, that you can't void something without a manager coming over and putting their key in? Well, the reason that's there is that this way the cash register person doesn't ring up the order and then void it afterwards and take all of the cash that you've just been given, okay, unless you go out the door with your product. All right, so there's a lot of internal controls that you see on a day-to-day basis that are put into place. Well, in a business, they're put in at a much higher level. Now let's go to the Sarbanes-Oxley Act. The Sarbanes-Oxley Act of 2002, you may have heard the word SOX, S-O-X. It's a lot easier to say than Sarbanes-Oxley. SOX was put into place because of some massive failings of internal control. And one of the major massive failings of internal control is with a company you may have heard of named Enron. And if you have the chance, I would highly recommend seeing the documentary. It's actually incredibly well done. It's more movie-like than anything. And the movie is Enron, the smartest guys in the room. And it's incredibly well made, and it talks about the downfall of Enron and all of the massive failings of internal control that caused Enron to fail. Okay, so Sarbanes-Oxley, what it did was, well, all right, so Enron failed, and that happened in, I want to say, 2001. All right, that it really went down, and it was a huge company, and it took down one of the biggest accounting firms in the world when it went down. I'll let you read up on that on your own. But it really shook consumer confidence, and people were almost afraid to start investing again because so many people lost so much money with the downfall of Enron. Right on the heels of Enron, there were two other scandals. There was WorldCom and there was Tyco. I mean, within a year. Okay, WorldCom, what they had done in a nutshell was, instead of recording expenses, items that should have been expenses, and think about what an expense does. An expense draws down your income, right? You'd wind up with less income if you had more expenses. So what they did was, instead of recording things as expenses in the period, what they did instead was they capitalized them. They made them assets on their balance sheet. So instead of showing less net income, they showed more net income. And now they showed more assets on the balance sheet, because what they were going to do is depreciate those assets over 20 years. So it's kind of like spreading the expense out over 20 years. So with that, when they had to restate their financial statements, it was huge amounts of money that they wound up losing when they got caught doing this, and they had to restate all of their financial statements for several years. Okay, so that was another thing. How could it possibly have happened that for years this company has gone on doing this? And the third one was Tyco, and Tyco was pretty interesting unto itself. This had been going on for more than a few years, and off the top of my head, I can't remember the name of the CEO, but what he had done was he was treating the business like his own personal piggy bank. He was doing things like, I want to say he had a party on a yacht for his wife at the time. He had Jimmy Buffett come and sing. It was like $1 million or $2 million party, and he put it all through as a business expense, yacht and everything. Okay, it's really an interesting thing to read up on. So with all these three major companies having these huge problems, all internal control related, consumer confidence was so shook that people were terrified to invest their money. They're saying, how can I invest my money? How can I be sure that the financial statements are good when all of these things are happening? How can I rely on the systems that are in place? So with that came the Sarbanes-Oxley Act. And Sarbanes and Oxley are actually the names of the two people who put the act into play. I want to say congressman, but I could be wrong. Who put the act into play. And what it is the Sarbanes-Oxley Act put a much stricter, put many rules into place about financial statements and internal controls of companies, and who's allowed to audit the companies, and so on and so forth. So whereas internal controls, the auditing of internal controls was not lax, but it wasn't as important as the auditing of financial statements, now public companies are required to have full audits of their internal control systems. So not only do you have an audit of financial statements, they also have an entire audit for just internal controls of a company to kind of try to make sure these checks and balances are in place to prevent some of these things from happening again. All right, so what does that mean for accountants? It means more jobs because now we have 2 audits to do. Okay, so moving on from here.